Hi, my name's Marty Straka, and I'm a mortgage loan specialist. I've been in the mortgage industry since 1990, and I'm going to answer some common questions that come up to me during the mortgage process when I'm working with clients. Let's get started.
What's an origination fee?
Well, it costs a lender money to create a mortgage. In most cases, in most lenders, it can actually cost anywhere from $3,000 to $4,000 in order for that lender to completely process and close your mortgage application loan. There's a tremendous amount of work that goes on in the background, document scanning, registering, processing, underwriting, etc. And the lender needs to be reimbursed for those fees. So what they'll sometimes do is they'll ask the client, as an exchange and interest rate, say, please pay an origination fee, to cost to originate that mortgage. And in most cases, it represents a percent of the loan amount, usually 1% of the loan amount. And the idea is that if you pay that origination fee up front, you've immediately offset the cost to create that loan for the lender. And so in exchange, they're going to give you a slightly more competitive interest rate.
What's a discount point then?
Well, it's an excellent question. A discount point is, and let's talk about what points are. Points is a slang term, stands for paid on interest up front. And the exchange of value is, it costs money to create a loan, and the people who have invested the money to create that mortgage back to you, they want to know how fast they can get a return on that money. So for instance, let's say if you were looking at a mortgage with no origination fees and no discount points, and the interest rate on that loan was 5.5%. Well, you might want to explore the idea of saying, well, if I pay an origination fee of 1% of the loan amount, and again, points, paid on interest, many people misunderstand this. A point is a percentage of the loan amount. So if you're borrowing $100,000, 1 point would be $1,000. Many people confuse that and say, well, a point is $1,000. No, because if you're borrowing $200,000, 1 point paid on interest up front is now a $2,000 fee. So points, whether they're a discount point or an origination point, are always based as a percentage of the loan amount. So now let's think about a scale of economics for a second, and let's say that a 0-point loan is at 5.5%. And you say, well, I'm willing to pay some additional cash up front, so I'm willing to pay some points and increase my cost. And I'll in turn turn around and say, well, if you pay me 1 point up front as an origination fee, instead of 5.5%, I might give you 5.25%. And if you pay me 2 points, 1 origination and 1 discount point, discounting the rate of the note, now I'm going to turn around and offer you maybe a 5% interest rate. Now this literally changes every single day in the mortgage market. Interest rates never change. 5% is 5% and 5.5% is 5.5%. What changes is the actual cost to obtain that money. And in some cases, you might have to pay discount points to buy that rate. And in some cases, you might be actually get money back from a lender to help offset the cost of your loan by paying a higher interest rate in exchange for lower costs up front. Origination fees help offset the cost of the loan up front. Discount points is a prepaying of interest in order to buy the rate down permanently over the life of the loan. Take the time to do the math. In most cases, if you're going to be in your home for more than 3 years, paying discount points and origination fees could make very good financial sense, providing, of course, you have the money to pay it up front.
Well, how are rates determined?
Well, there's a million things that go into what costs an interest rate to be out on the public. Basically, lenders are lending the money, and a good analogy I like to think is if you think of the old Yosemite Sam cartoons. Yosemite Sam ran into the bank, came running out of the bank with his guns a-blazing and his bags of cash. And as he went to leave the bank, he went over to the window and he erased how much money was on deposit. Well, if the bank doesn't have money on deposits, how can it lend the money? It has to get it from somewhere else. Many, many years ago, there was a thing called the secondary market that was created. So now this allows people to invest part of their money from their retirement plan and their savings, and they give it to the banks, so the banks can then in turn lend it to people who can use it to borrow mortgages. So what you want to look at is very simply, what's going to cause the interest rates to go up or down is what's the risks associated with the investment. The interest rates are determined by the secondary market, where the market's expected to go in the future, and whether or not the economy is heading up or heading down. Interest rates basically stay in a fairly steady range, a couple of days at a time, but they have been known to make as much as 0.5% swing in as little as 24 hours. So if you're thinking about getting a mortgage, I'd always recommend lock that interest rate in up front. It's not worth taking the risk. You might save 0.1%, but you could easily lose 0.25% or more.
Well, how can I compare rates and fees when I'm shopping for a mortgage?
Ask a lot of questions. Ask for information in writing. It doesn't matter what was told to you over telephone. If you don't have it in writing, it's not valid. And anybody who's legitimately in the mortgage industry, how could they possibly be in the mortgage industry if they're not willing to give you documentation to support what they're telling you? Ask for a closing cost worksheet. Ask for a breakdown of what all your fees are going to be up front. Be very specific in your questions. Now, there's been recent changes in the Mortgage Disclosure Information Act that make it a lot easier for the consumer to understand what's going on. But still, don't trust anybody. Ask a lot of questions. Ask for everything in writing. Anybody that's not willing to give you information in writing, that's somebody you should be cautious of.
Okay. Well, what's the difference between APR and interest rate?
Ah, there's a great question, and one that very few people can actually understand. APR stands for annual percentage rate, and this is a formula that was calculated by the federal government as part of the Truth in Lending Disclosure Act, where they try to explain to you as the customer that it's not what the note rate is that's costing you in the long run, it's the annual percentage rate, or APR. And what they try to explain to you as the customer is, okay, if you were going to borrow $200,000, and if you didn't have any lender fees associated with this loan whatsoever, then you'd only borrow $200,000. But if the lender's requiring you to pay $6,000 in fees up front for appraisals and title costs and whatever, that if you didn't have to pay those fees, you would borrow less money. So they come out with this formula, and very few people really understand it. But the theory behind it is, if you take that $200,000 and say, well, we're going to add $6,000 to the cost of the loan. If you didn't have to pay that $6,000, instead of borrowing $200,000, you would have only borrowed $194,000. But if your payment is still $1,200 a month, and you're only borrowing $194,000, isn't effectively the interest rate higher? And that's where they come up with this formula called an annual percentage rate. It's supposed to help you in understanding and how to properly shop for a mortgage, but regretfully, there's not a hard and fast rule as to what every lender has to include in those fees. And literally, the day of the month that you're going to close on your loan can affect what your annual percentage rate is. If you close on the loan at the last day of the month, you'll have a lower annual percentage rate than if you closed on the third day of the month. So many things can impact the APR. Just ask for everything in writing. Compare lenders face to face on the paperwork in front of you, and it should be pretty easy for you to understand. Any lender that won't give you information guaranteed in writing up front, there's something wrong with that picture. Get it in writing, it should be easy to understand.
You talked about locking in a rate. What's the difference between locking and floating?
Well, it's sort of like saying you know what tonight's winning lottery numbers are going to be. You're just trying to decide if you want to buy the ticket. If you're looking to borrow money and the interest rate today that you're being quoted by a lender is, let's just say, 5%. Well, do you want that 5% rate when you come to closing? Because if you do, you need to lock it in. Otherwise, you're willing to take on the risk as to what's going to happen in the marketplace. While interest rates tend to move fairly slowly over time, there have been cases where interest rates have changed over 0.5% literally in 24 hours. These are challenging economic times on many levels, and many things affect the ultimate cost of a loan. My personal belief, if you're looking at borrowing mortgage money, and if a 5% interest rate is, or whatever the interest rate that's quoted the day you ask for it, if that sounds good to you, lock it in and eliminate the risk. Because it doesn't matter if you know what tonight's winning lottery numbers are. If you didn't buy the ticket, you don't get to win.
Well, when can I actually get a rate lock, and about what does it cost?
Well, you should be able to get an interest rate lock in at any time that you actually put in your mortgage application. Now, most mortgage lenders are going to require to know the minimum required information of your name, address, telephone number, how to reach you, your social security number, and the property information in order to lock in an interest rate. Some other lenders will require that they have their entire actual mortgage application package before they'll lock in your loan. It's important to ask the lender what their specific policy is. Many lenders don't charge anything to actually lock in a loan. Now, the standard rate lock periods usually run 30, 45, or 60 days. They may require some upfront money from you if you want to get an extended rate lock. But it really, in most cases, does not cost anything as an actual out-of-pocket expense to lock in a loan.
That sounds great. If I've got any other questions, what's the best way to reach you?
Well, I always have my cell phone with me, and that's the best way to reach me. I cheerfully take telephone calls anytime after 7 a.m. in the morning, anytime up until 11 o'clock in the evening. My cell phone number is 973-598-5006. I'm Marty Straka, and I'm looking forward to helping you.